Good afternoon, everyone. We will wait a couple more minutes and see if anyone else jumps on. Good afternoon, everyone. We are going to go ahead and get started. Thank you for joining our second month of our Beginning Farmer Rancher webinar series. The first month we went over all of our agencies. This webinar series is a collaboration between us, the Farm Service Agency, also known as FSA, our sister agency, NRCS, or the Natural Resource Conservation Service, the Risk Management Agency, RMA, and Rural Development, RD. So like I said, the first one went over general agencies and what we can provide to our producers. All of that information is listed on our Colorado FSA website, and I can send it out after if you would like. But my name is Liz Thomas. I am the Outreach and Communications Specialist for the Farm Service Agency. A couple quick notes on this meeting. It is being recorded and transcribed. We will be taking questions throughout the presentation. This month specifically, we are going to be going over FSA and farm loans. So I'm going to go ahead and share my screen here. So like I said, this month's topic is farm loans. We're going to start off with a couple introductions from some of our other agencies and people that we have on the call. And then we'll go over farm loans, questions about loans, all USDA programs, deadlines and important dates that we have coming up, our future webinar dates and topics, and then contacts, how you can contact us, and other questions. Like I said, for introductions, my name's Liz Thomas. I'm the Outreach and Communications Specialist. I reside within Colorado at the Colorado State Office, and I'm happy to be here. I'm going to transition it over to Kim Lacey to introduce herself, and then we'll go on from there.
Hello, I'm Kim Lacey. I'm also a member of the Colorado State FSA office. I specifically work on the farm loan side of it, so I'm a state farm loan specialist. I can tell a little bit about myself once we get started with the loans.
Thanks, Kim.
Hello, I'm Cindy Einspar. I am with NRCS and I'm the Outreach Coordinator for NRCS for the state and the Beginning Farmer and Rancher Coordinator. I'm glad you're all on today.
Hi, everyone. I'm Amy Munn. I am the Public Information Officer here for Rural Development in the state of Colorado. And just welcome to the webinar.
Good afternoon, everybody. I'm Jeff Darrow with the Risk Management Agency. Our office is based in Topeka, Kansas, but we do work on crop insurance issues and with producers on crop insurance policies for the states of Kansas, Colorado, Missouri, and Nebraska.
Thanks, everyone. We are all really excited to have you all here, but we will go ahead and get started with our loans. Take it away, Kim.
All right, thanks, Liz. So I guess just to tell you a little bit about myself, as I said, I'm the state farm loan specialist for Colorado. I've been working for the agency for 16 years. Before coming to the state office, I was the farm loan manager over several counties in northeastern Colorado. I started in the Weld County office, but primarily have been working through the northeastern part of our state. As a member of the state office now, typically as a specialist in our state office staff, what our role is we're really just supporting our field staff and who are working with the producers in the county office. So typically, as far as state office goes, they're going to be just requesting clarifications on policy. We'll also be assisting and consulting with national office on any questions that may arise. We also work on some of the more complex issues like bankruptcies, guaranteed loss claims, debt settlements, environmental issues, and things like that. We also assist our county office in training new loan officers and new employees coming on. But typically, as a producer, you'd be working primarily with your county offices, the local loan officers and farm loan managers in those offices. So for FSA farm loan programs, our goal is to provide loans to producers, directly to producers. We're also working on loan guarantees with commercial lenders, as well as working with producers to just plan and build their operations. With all loans, we do work to establish short and long-term goals for the operation. In doing so, we try to be mindful of the loan requests that are coming in and making sure that the way that we're structuring the loans as they're coming in are really the best way to structure that in terms of taking into account the goals of an operation, not just now and what they're trying to accomplish today, but also what they're looking to accomplish 3, 5, or 10 years from now. So although there's a lot of information online and you have the ability to apply online now, get all your information online, I just encourage you to reach out to your local county offices. The experience that they have and knowing the types of loans that we have and some of the great servicing or structuring options that we have, nothing can replace that. So although you can get all the information online, I will always encourage you to also reach out to your local county offices to start those discussions and really make a plan that you feel like will work not only today, but kind of going on in the future. So when we're looking at farm loans, I think one of the things that makes farm loans really fun is that every operation is different. Every operation has its strengths, it has their weaknesses, and that's really what keeps farm loans dynamic. So also as you're applying for a loan, your experience, depending on what you're applying for and what your needs are for your operation, can look a little bit different from maybe your neighbors or those around you. So just also know that that's just the great resource of working with those field offices, is that they can provide assistance to those questions and just kind of advise you on the different eligibility requirements and hopefully be able to develop a feasible plan for operation. So as we look through the farm loans, there's 2 main types of loans that we want to talk about today. The first loan is going to be just our regular direct farm loans. Those are loans that are made directly from FSA to the producers directly. With that, FSA is going to have the responsibility for making and servicing these loans directly with their producers. The second type of loan that we have is the guaranteed loans. With the guaranteed loans are made and serviced by commercial lenders, such as banks, the farm credit system, sometimes a credit union, or other non-traditional lenders. FSA guarantees, what they're doing is the bank is requesting to back up that loan in case of a loss. And what they can do is they can request that FSA back up that loan between typically a 90 to a 95% guarantee. With that, FSA has the responsibility of just approving eligible loan guarantees and then helping provide oversight for that guarantee for the lender. With guarantees, those are very different in terms of the producer is working directly with their bank, and the commercial lender, the bank, is going to be working with FSA on the backside to maintain that loan, that guaranteed loan with FSA. So with a direct loan, we're working directly with producers. With a guaranteed loan, you're going to be working with your bank, and you're probably going to have very little contact with us in regards to the loan process. Both direct and guaranteed loans have farm ownership and farm operating loans. For both of these loan types, we'll get into the details and dig it a little bit deeper in the next few slides here. But the basics would be that farm ownership loans are used to purchase or improve real estate, while operating loans would be used either as a term loan to purchase something such as equipment and livestock, and annual operating loans, which would be used to pay your annual operating expenses. The last item listed there was just business planning to eligible farmers and ranchers. And some of that can come into play as we said before, looking at short and long-term goals of the operation. Typically, that business planning can happen also if you're working with a lender and you're not really understanding maybe what the lender's needing. The loan officers at your local county offices are great resources in terms of sharing, again, all of their knowledge and experience and trying to figure out what financing can be best for you. All right, next. Okay, with all of our loans, like we said, we kind of talked about the direct farm ownership loans, operating loans, and lastly there, I just say the emergency loans. Emergency loans are loans that are useful in helping producers when they have experienced a loss in production or physical losses due to drought, flooding, or other natural disasters. Again, we have both ownership and operating loans available for the emergency loans. However, one of the biggest differences is that it's only offered through the direct loan side and not offered through commercial lenders utilizing that guarantee. All right, next. So the first step in looking at the farm loan program, I guess, is to understand that there's two primary things we're going to be assessing when reviewing an application. The first thing is going to be the eligibility. Do you meet all the eligibility requirements? The second thing is going to be feasibility, which means have we been able to develop a feasible operating plan that's going to show repayment not only to FSA's loan, but to all of the obligations, including within the operating plan. So as we dig into the basic eligibility requirements, one thing to know is that there's two different types of eligibility. There's just our general eligibility, and then there's an increased eligibility specifically for farm ownership loans. So let's look at just the general eligibility. The general eligibility is going to apply towards operating loans as well as the farm ownership loans. First item up here is a U.S. citizen. The applicant, anyone who will sign the promissory note, must be a citizen of the United States, a U.S. non-citizen, national, or a qualified alien under the federal immigration law. Second one would be that it must be a family-sized farm. So a family-sized farm means a business operation where the producer that produces agricultural commodities for sale and of sufficient quantities so that it really is recognized as a farm rather than a rural residence. We also want to see that it has both physical labor and management happening on a majority of the day-to-day operations. Operational decisions and strategic management decisions should also be made by the applicants, right? The borrowers and the members that are responsible for the operating plan, we also want to see them providing a substantial amount of the labor. That's not to say that we can't have our operators be able to use full-time hired laborers, but that should just be to supplement family labor. Producers can also use just reasonable amounts of temporary labor for seasonal or peak workload periods, and then just intermittently for labor-intensive activities as well. The third one there is going to be credit elsewhere. So what this means is that, let's go to legal, legal capacity first before we jump into credit elsewhere. Legal capacity for the loan. So when we look at what legal capacity means for the loan, we are going to look at that the applicant should be of legal age, they should be of mental capacity, and they should have the authority to legally, enter into a binding agreement and commit to that loan. If the applicant is an entity, all members need to meet this requirement. For entities that have members who have not reached that age of majority, they will be considered ineligible, as one of the requirements for entities is that all entity members must sign promissory note as an individual. Entities are going to include things like corporations, joint operations, partnerships, LLCs, noting there that nonprofit organizations are not eligible to receive FSA assistance. Also, we want to note that all entity members are required to be able to meet all of our individual eligibility requirements as well. So within the next one, as far as the credit elsewhere goes, what that means is that we're looking to see if the producer would be able to obtain credit elsewhere, but meaning with a commercial lender or other as under reasonable rates and terms. But with that, we want to make sure that reasonable rates and terms do meet the actual needs of the producer. If you're going through a commercial lender with FSA, we don't want FSA to be in competition with commercial lenders. We are here to support the producer as you're working to obtain commercial credit. We always have a goal of being a temporary source of credit and a producer being able to graduate onto commercial credit. But understanding that FSA's role really is to try to bridge that gap into getting producers operating and still trying to not be in competition with the commercial side. As we know that the commercial side, they really can't compete with our rates and our terms in that regard. So with that, you do not have to apply for a commercial loan prior to coming to FSA and submitting an application. That used to be the requirement, but it is no longer. We can utilize the application itself to determine if we do think that you would meet the need or meet the criteria for a commercial lender. And if we receive, your cash flow and your balance sheet, and of course we work with commercial lenders a lot on our guaranteed loans, so we do know the requirements, typical requirements of what our guaranteed lenders are wanting to see from their borrowers. So if we do receive your application and it does appear that you could get commercial credit, we will work with you as the applicant to try to obtain that commercial credit. But also if you're not able to get that credit, then we're going to continue on with the loan process. So just know that you do not have to have a denial letter in order to come and apply through FSA. The next one here is just credit history. I know that's one thing that it's a very broad thing, but when we're looking at credit history, we don't base this just off of a credit score. We will pull our credit report, but being that we work with beginning operators, it's not uncommon to receive a 0 credit score as the producer maybe hasn't had any debt before. We do use our credit report just to assess past repayment problems or verify current debts. The credit history factor should really be assessed as a part of an applicant's comprehensive credit history, rather than just one single disqualifying factor. While maybe a derogatory history could result in an eligibility determination, we really do want to look that maybe that wasn't an isolated issue with a circumstance beyond the applicant's control. We do want to look to make sure that, but also we do need to take into consideration that the applicant has made best efforts to meet their prior obligations, and that with us, they'd be willing to carry out the terms and the conditions of our loans that we'll be making, just as they have fulfilled other obligations with other parties. The loan officer can also determine that maybe that an applicant hasn't acted in good faith. That's not typically something I think we run across, but there have been times where we've had applicants deliberately falsify information or intentionally omit information that would be relevant to our loan decision. So just knowing that as we're working to put these applications together, we really do want to lay all of our cards on the table and really look at, maybe what are some of the challenges that have gone on with someone's credit history. Is that something that we can work with? Again, are there ways that we can maybe utilize our loans to restructure some things for this producer? This becomes increasingly important, especially if we're working with beginning operators who may have leaned on maybe a non-traditional line of credit or high interest rate credit cards to finance their early farming interest. I mean, those are really discussions that we want to have with all of our producers to assess maybe some of the issues that we could see when it comes to credit history. So just again, working with your loan approval officials as you're trying to work through a complete application. That's the best route there. Also, we want to make sure that producers have not received prior debt forgiveness from FSA and not been delinquent on any other federal debt, including debt with other federal agencies. We want to make sure that there's no outstanding unpaid judgments obtained. And if there is something, we want to make sure that maybe that it's possible to get those things cleaned up so we can continue on meeting the producer's needs in terms of what they're needing to do for their operation. And again, we kind of mentioned it before, but just producers not providing any false or misleading information or documents. That just goes back to that good faith determination there. Another item is that there should be no disqualification from federal crop insurance violations. We don't, not having been convicted under federal law or state laws of planting, cultivating, growing, producing, harvesting, storing, any kind of controlled substance within the last 5 crop years. The other item there that I think is probably one of the biggest one is that the producer demonstrates managerial ability. And this is either the individual holding the majority of the interest in the entity or the individual who's responsible for the day-to-day operations of an entity. They must all demonstrate that they have sufficient managerial ability for that operation. Understanding that we are working with beginning operators, and we do know that, like, as working with beginning operators, we're going to be assessing maybe what the needs are of that applicant. Do they need some borrower training? We do have a part of our eligibility determinations is to assess if there are borrower training needs of the operator. Are there financial or production training that could be required as a loan condition if that loan is made? And also, as we're assessing the level of management ability, that depends again on the operation and the complexity of the operation. And really what we're looking for there, that the applicant should really be able to demonstrate that they have the knowledge and that they maybe assisted in the past or they've got some mentorship in place to carry out their operation and follow those standard practices within their operation, what they're looking to do. We also just want to make sure that we are just working directly with the loan officers to demonstrate that managerial ability. One thing I can say is that, working in a field office level, it really wasn't uncommon to have parents inquiring for their kids for, different loan requests. And although it's great to have the backing and support of, the family, parents and family operation for a family operation, one thing that I always really try to stress to those parents is that when the application is made, and even as we're looking to visit about an inquiry for a loan, we really want to have those conversations directly with the applicant, directly with who our borrower would be. Through those conversations, through the producer, the applicant knowing, what's required for the application and working through to get a complete application. Those are the things that allow us to assess that managerial ability, and we just can't do that if we're not working directly with the applicant. So in my opinion and suggestion would be that if you're looking to do that, or if you're kind of inquiring for a child or anything of that nature, just always make sure that they're along with you on those meetings, because we definitely want them to know what they're getting into, what that means. All right, next one. Okay, we talked a little bit about, I said that there's 2 different types of eligibility. Well, all of that long list of things that we just addressed is the eligibility for general eligibility. And then as we get into the farm ownership eligibility, that's where we have a few other requirements. Obviously, taking into consideration that purchasing real estate is a much bigger commitment than purchasing livestock or purchasing some equipment or just taking out an annual operating loan. So as we are looking at the farm ownership loans, there are some additional eligibility requirements that we want to take into consideration. The first one here is going to be the farm experience. So in addition to meeting just the general eligibility requirements, we also need to assess the farm experience factor. And this can mean that a producer must have participated in the business operations of a farm for at least 3 out of the last 10 years. And then with that, we do want to make sure that it says, that it's an operator for the farm or ranch with significant responsibility, or raised on the farm and ranch with managerial decisions working on the farm, or has managed someone else's operation for that matter. With farm experience, the one thing I will say is obviously we are working with beginning operators. So we know that sometimes it does take a little bit of time to get that experience in. But what we'll do is if you've been working for someone else's operation or your family operation, what we would require is that we're able to verify that your experience with that, or with your experience and your participation within someone else's operation, which primarily is going to be through those persons providing written statements with the knowledge and the being able to provide like what the knowledge is of the applicant's role and responsibilities in their operation. And really with that, what we're trying to indicate is that the applicant would not solely be just hired as a laborer, but they would be a part of those day-to-day managerial and operating decisions that are needing to be made. Because of course, as we're looking at making these loan requests, we know that we're looking at not just, this isn't just a loan request, but we really are looking at, this is a business request as well. So when we're looking at these farm ownership loans, and we know that this is probably going to be a 20, 30, 40-year loan, that is something that we're taking into consideration. So again, I would always encourage you to visit with your local loan staff to try to help assess some of these questions that you may have in regards to experience. Sometimes, again, that means assessing goals on that 3, 5, 10-year experience, 3, 5, 10-year increments, right? So maybe the goal for this, because you're just getting started, would be to get an operating loan and lease some ground with the goal of purchasing your own real estate within 2 to 3 years. So we definitely just want to sit down and have those conversations and get a game plan as we're working with each applicant. Next slide. So as we're looking through talking about trying to meet that 3 out of the last 10 year rule, it's important to know that we can substitute 1 to 2 years with some other items here. And the first item would be just the post-secondary education in an ag-related field. Successful completion of that farm management curriculum, 1 year experience with substantial management responsibility. Also, if you completed an internship, other significant business management experience, of course. If there was an honorable discharge from the armed forces, as well as if you maybe had been a prior FSA youth loan borrower, or if you were working with and had an established relationship with that service corps of retired executive programs. I know that that's been something that there's been limited availability within, but I hope it's something that I do hope that can continue to grow. Next one. Okay, so let's talk directly about some of the different farm loan options that we have. Just leading off here, we're going to talk about the farm ownership loans. Again, these are going to be used primarily to purchase a farm, enlarge an existing farm, or just do some kind of new constructions or improvements maybe that need to happen for an operation. The one note here is that direct farm loans cannot be used currently to refinance real estate. So if you already have an existing loan, we cannot utilize presently, we cannot utilize our farm ownership loans to refinance real estate. Direct loans, they have a maximum of $600,000. We can look at financing a farm purchase up to 100% of the purchase price, as long as it would be under that $600,000. And when I say purchase price, that could be the lesser of obviously the purchase price or appraised value, right? Because we do need to at least meet our security requirements on a one-to-one basis. We also have what we call a joint financing or a participation. Within that, the participation loan also has a $600,000 limit. These can be great. These loans are used in conjunction with a commercial lender. Participation loan, FSA can finance up to 50% of the purchase, and the commercial bank, they would provide the other 50% financing, right? In this case, FSA is kind of acting like the down payment for a loan. And just noting that although we can do up to the 50% of the purchase price, that it's not always 50%. Sometimes we're 30% of the purchase price. Just kind of whatever, again, but looking at the need of the producer. The way that the farm ownership participation loans or joint financing loans work is that FSA takes a second lien behind that commercial lender. So again, we're just kind of acting as that down payment essentially to help producers get onto ground. The bank, knowing that most banks are going to require probably a 30% down payment is what would probably be standard. The bank, of course, on the loan that they have, you're going to have two separate loans. You're going to have your loan with the bank. You're going to have your direct loan from FSA. The bank's going to have their own rates and their own terms. We don't put stipulations on that for the participation loan. FSA, when we look at our interest rates, there's an interest rate that you'll see there that says for March of 2024, and it's at 5.25%. Within that March, that is for if we were doing 100% financing, we're going to do the 5.25%. Joint financing or participation loan, that has the rate of the 3.25%. The reason we give that lower rate there for the joint financing is really to look at saying that we understand that a commercial rate is probably going to be higher than our 5.25. So by giving you that lower rate on the joint financing, we are able to kind of help bridge that gap a little bit in the cash flow and hopefully make feasibility a little bit more attainable and still encouraging that joint financing. When we're looking at what kind of terms that we want to do, we can't exceed 40 years. We are required to look at each loan and determine what is the lowest term that we could do without putting a financial stress on the operation. And so again, those are things that your loan officers are going to be working through as they're assessing applications, and they're going to be communicating with you too. If it's not that standard 40 years or that maximum 40 years, they're going to be communicating why they would be required to do a lesser term. Also, just to note that the farm ownership loans are not just a one-time thing. You have eligibility timeframes for 10 years. So it's 10 years from the time you close a loan to 10 years between the time you close the next one. So if you were looking at a $600,000 purchase, technically, yes, FSA could do the whole purchase, right? But you could also look at doing a joint financing where the bank provides $300,000 and FSA provides $300,000. And then you've only used $300,000 of the $600,000 that's available to you. So again, that can provide some ability to utilize the FSA program again to purchase or expand the operation in the future. So that's why I say, as you're looking at some of these different, options, it's always great to just sit down with your loan officer and be able to have those discussions of what doesn't just fit the need today, but what do you want to do 3, 4, 5, 6 years, 10 years from now, right? All right, and then I'll talk a little bit on the next one about our other farm ownership loan options. Liz, if you'll go to the next. Okay, so right in line with our joint financing option, the participation loan, we also have what they call the down payment program. With the down payment program, it's very similar in that is a joint financing. However, there are some important differences. Really like this loan option for the right producer. One of the biggest differences is that you must be to be eligible for this one, you must be a beginning farmer or socially disadvantaged applicant. Now, our other programs that our other loan options that we're going to talk about, you can be both a non-beginning, you can be a non-beginning farmer. And we'll go into that a little bit later when we talk about some targeted funding. But a requirement for the down payment loan is that you do have to be a beginning farmer or socially disadvantaged applicant. You must also not own more than 30% of the average farm size for the county where you're going to be farming. That would affect your beginning farmer status, right? Also, as the way this structure works is it works kind of like a 50%, 45%, 5%, and that the applicant is required to put 5% cash down. FSA can provide up to 45% of the purchase price, with a maximum on this one of $300,000, $150,000. So when we look at this, and then of course the bank would be doing the other 50%. So when we look at this, we see the difference with our maximum there being from $300,000 for the down payment loan, whereas the other ones are $600,000. And when they increased our farm loan limits, I believe it was in 2018, from 300 to 600,000. This is the only one that did not get changed too. So this one we are still maxed out with 300,000. Again, FSA can provide up to 45%. It doesn't always have to be, 45%. Sometimes a producer will put down because they sold another house or something like that. Maybe they're going to put down 15 to 20%, and they just need FSA. They like to utilize FSA's help for 20% of the loan, and the bank's going to do 50. Whatever we need to do there, we're willing to sit down and kind of have those conversations on what might work, right? But within that, our maximum is the 300,000. Now, with FSA's portion of the loan, we are going to do a 20-year term maximum with a 1.5% interest rate. Then the bank, of course, they're going to have, again, their own interest rate. But with this one, we require a minimum amortization of 30 years, and there can't be a balloon installment payment within the first 20 years. Now, another interesting note on this one is that by putting that 5% cash down, or minimum of 5% cash down, by putting a minimum of 5% cash down, the only security required for this loan is just the real estate that's being purchased. There's no additional security requirements. We're just going to be taking a lien only on the real estate that's being purchased for this loan. Also, within this loan, if by putting the 5% cash down, if the bank who's providing the 50% of the financing, if they wanted to request a loan guarantee on that 50%, they could request that guarantee at no fee to you as the producer. So it's kind of a free guarantee for the bank, but it would be a saving for you and not having to pay a guarantee fee, which we'll talk a little bit more about the guarantee loans and how that fee works in the next few slides. So great. Again, I love this loan for the right producer, but it is good just to know what all the options are. So, all right, next one. Okay, next one is just the direct operating loans. So maximum for the direct operating loans is $400,000. Within that can include, again, our 7-year term loans, which are usually used to purchase equipment, livestock. It can also do a 1-year annual operating. Unlike a lot of banks, we don't have the ability to do a revolving line of credit. So this is a 1-year loan. Sometimes we can go up to like 18 months and things like that, depending on, the need of an operation. But we are looking at a 1-year note. So you're going to take out your loan for this operating year, pay it off, and then you'll have to reapply for your loan for your operating loan for next year. Okay, it's a closed loan in that regard. The interest rate is currently for March is at 4.875%. I will say this, the way the interest rates work is that we get new interest rates at the beginning of every month. When we're looking at a farm ownership or operating loan where the interest rates change from the time you apply to the time you close, what we look at is we lock in your rate based on either the month that you are approved or the month that you close. So for instance, if you're doing a farm ownership loan and I approve your loan in March of 2024, but because we wait on an appraisal and things like that to come back, we don't actually close the loan until May of 2024. And let's say the rate goes down, we're going to give you the lower rate of May of the month that you're closing. So those are things that, again, we're constantly looking at and adjusting to try to give the producer the lowest rate possible. All right, next. Right. The next section here is just the microloans. With all of the loans we've talked about, whether for the farm operating loan as well as the farm ownership loans, we do have microloans available. A microloan is if you are can stay under the $50,000 limit. And that's a $50,000 limit for operating and $50,000 limit for farm ownership. The benefit of a microloan is it really is more of an abbreviated application. You're still required to meet eligibility requirements. You're still required to be able to develop a feasible operating plan, but you do not have to provide as much information for a microloan as you would the other loans that are greater than $50,000. This is a great stair step, if you will, for some of the smaller operations or operations who just have a smaller need. And also, one thing about microloans is it doesn't count against you in terms of your term limits for our loan. So lots of good things if you're ever putting in a request for under 50,000, and that's something most all loan officers are going to be really communicating the benefits of applying as a microloan versus the traditional operating or ownership, just to help you out in that way. But it also does have the same interest rate, so no differences on that side of things. One loan, and I'm just going to talk on this one really quick before we kind of get into the next slide, is we didn't talk about and it isn't in these slides, is the youth loan. And I mentioned it very briefly, but youth loans are made to kids within the ages of 10 to 20 years old. We have a maximum of $5,000 for those. Those can be made again from either a 1-year operating to a 7-year term. Same interest rates as typical operating loans. With that, the youth does have to be involved in a project or at least be sponsored by a project advisor such as 4-H or FFA or like a tribal youth organization or some other kind of agricultural affiliated group. These can be a great just educational experience for youth who are looking to maybe have a 4-H project or an FFA SAE project or something of that nature. So that's just another little highlight on a different loan type that's not featured here. All right, next. All right, we'll talk a little bit just about the guaranteed loan program. Again, these loans are made directly from FSA to the producer, or directly from the bank to the producer. FSA, you're working with FSA on the back side of it, right? With this, you're going to see a significant difference in terms of the maximum loan amount. So for 2024, the maximum is that $2,236,000. They do adjust that annually, but that is the 2024 limit. So we do see a significant difference. Again, like we kind of talked about stair stepping a little bit, this is that next step. So FSA's got the $600,000 maximum, $400,000 maximum on the operating notes. Guarantee is much higher. So we're, again, looking to try to help producers grow in their operation. These guarantees are a great opportunity to really bridge that gap, right? Take a producer from the direct side over to the guaranteed side. But a producer is not required to have a direct loan prior to taking out a guaranteed loan. Really, the point of the guarantee is to assist a commercial lender with being more comfortable with that loan. Maybe there's something about the producers, either maybe their cash flow or maybe their balance sheet, or maybe they lack experience. There's something that would hold the bank up from being able to approve this loan. With an FSA guarantee, if they can get it approved, that's a great thing for us. When we look at the types of loans, guaranteed loans that we have, we do the ownership loans, of course, still with that 40-year term repayment term limit. Again, we do the regular operating loans, either from like a 1 to a 7-year loan, if you're doing like a chattel secured. But with this one, we do have availability to do a 5-year line of credit. Again, the bank is managing all those loans. They're making those loans, they're servicing them. You're working directly with your lender. What the lender's going to be doing is they're going to be providing FSA just the information to obtain the guarantee, and then information annually to maintain that guarantee and keep that guarantee in good standing, so that in case of a loss claim on that loan, their loan would be backed up 90 to 95% typically. One of the, like, we don't have any maximums. I mean, we don't have any control over the interest rates there. We will assess them on our side to make sure that they're reasonable and that they meet some basic requirements. But the lenders will set their own interest rates and terms. Although our maximum is 40 years, it may be a bank policy that they don't do greater than 25 to 30. Those are things that are going to vary by each institution. Also, we are, of course, making sure that the loans are adequately secured. And then we talked a little bit about that guarantee fee. And what the guarantee fee is that's a one-time fee for the borrower. They'll be paying that, of course, through their bank. Sometimes those are built into the request amounts. And the 1.5%, you're paying 1.5% on the guaranteed portion of the loan. So if the bank is asking for a 95% or a 90% guarantee, you're paying that 1.5% on the 90% or the 95% that's being guaranteed, not on the 100% requested amount. Next. Okay, I kind of already talked about a little bit about all of those items. But within that, just know that as we're looking through the difference between maybe some of those percentages between that 90 to 95% guarantee, the 95% guarantees are typically given for SD socially disadvantaged producers, as well as beginning operators, as well as the down payment loan that we talked about earlier. Next. Okay, next one is just the emergency loans. Again, we talked just a little bit about this. Emergency loans, again, are just for producers who have suffered a loss due to like natural disaster or something of that nature. Emergency loans are being used to just restore and replace essential property or pay all or part of the production costs that are associated with that disaster year. Can also be used to pay essential family living expenses or to reorganize the farming operation or refinance certain debts. So the county or the counties where the farm is located must have been declared a disaster area, either by presidential or designated by Secretary of Agriculture. The production loss applicants must demonstrate that they have at least a 30% loss for the single family enterprise. Within that, these loans are only available as direct loans. And then they have a different maximum. They have a maximum of $500,000 or 100% of the actual production or physical losses. In the past, we've had some issues with these loans being funded, but in those times, we definitely were also utilizing our regular direct operating loans to still try to assist producers. But that doesn't seem to be the case here recently. And we definitely, again, as you're working with your loan officers on what the needs of your operation are, feel very confident in our Colorado loan officers to sit down and kind of work with you to gear you towards the best type of loan for your operation and for the needs, whether it's an emergency loan or direct loan. Next one. Okay, so the next one is just I already covered all that, I guess. Go ahead. Okay, so the next one is just talking about the targeted funds for FSA and how those work. So each year, Congress targets a certain percentage of farm ownership and farm operating loans specifically to beginning or socially disadvantaged producers. Within that, providing loan programs, is very important to these groups, and who have maybe historically had more difficulties in obtaining financing. So for all the loan options that we just discussed, there are beginning farmer, our socially disadvantaged options available. These are all made with the same eligibility requirements, the same interest rates, the same terms, same feasibility requirements. Just understand that there are targeted funds that are set aside so that, for instance, in a year of high loan demand where maybe loan pools, the loan funding is depleted, there may still be some loan funds available in maybe one of these two categories, either beginning farmer or as socially disadvantaged. So just know that those are things that we work very hard on to have those targeting fundings available, and Congress has done a great job supporting us in recent years in that. The down payment loan is really the only one where we specifically gear towards either beginning farmer or socially disadvantaged. Okay, as we look at targeted funds for SDA applicants, again, a percentage of all of those loans are set aside. When we're looking at that would be entities and members for American Indians or Alaska Natives, Asian, Black or African Americans, Native Hawaiians or Pacific Islanders, Hispanics, and as well as women. And again, any questions on that, please feel free to reach out to your loan officers. Next one. Hey, beginning farmers is a little bit different. As we look at what is beginning farmer, we are looking at that, again, looking at these things, making sure that they meet eligibility for requirements of, the direct or the guaranteed loan, especially for the down payment loan there. So within that, beginning farmer is considered to not have operated a farm for more than 10 years. And this applies to all members of an entity. So the other one is that for operating loans, that they do not own more than 30% of the median-sized farm for the county where that property is located. And again, work with your county office if you feel like you might be on the line or you want to know what that 30% is. The county offices will be able to provide that information to you. And then the thing I would say too that comes into play with any beginning farmer is that really being mindful of the date that you set as when you began operating, just because that can have an impact sometimes not only on your farm programs, but maybe other programs, not only farm loans, but other farm programs or other agency requests that you make. Just wanting to establish a consistent operating date is important. All right, so again, we kind of talked about it before. All of our loans require that we do show repayment ability and that they are adequately secured. We do not at this time have any kind of grants available through FSA, just only our loan programs. And then we touched also on it about FSA being that temporary source of credit. So if you can obtain financing through a commercial lender, we'll work with you to do so. And then again, once you do become a borrower, even though we may have a term of 7 years or 25 years or 40 years, we do have some present graduation requirements in place, and graduation would just be meaning to graduate on from FSA to a commercial lender. Assure you that we're never pushing anyone out before they're ready. We are going to sit down with our borrowers and have those discussions of why they need graduation and work with them to obtain other financing. The goal is never to graduate a producer before they're ready or before it would create a hardship for them. A little bit of information in terms of how to apply. They have developed a loan assistant tool, which is available online. It is really, it's great in providing just a good understanding of some of those eligibility requirements that we went through earlier. Also just discovering different FSA loan types and some of those requirements. It's very easy to understand. It walks you right through it. And it's just a great discovery tool. FSA just recently put out a new farm loan application ability to do that online. Keeping in mind that you know, that the farm loan application online is in its very, very early stages. So to apply for that loan, it is all open right now for only individuals who are only producers that are applying as individuals. It's not yet available for producers that are going to be applying as an LLC or as an entity. Again, brand new application. So national office keeps saying this is like the skateboard version. We haven't expanded to like the Cadillac version of that yet. So we hope that it's something that's going to continue to grow and to develop, and that we'll see great expansion and improvements on. But if you'd like to do that, or if you've tried to do that and you've experienced any errors or any issues, please reach out to us at the local offices so we can make sure that you know, we're getting your application in and keeping it moving. All of our forms are available at the USDA FSA website. Again, if I just really encourage you to kind of work with your local offices if you're interested in the guaranteed loan. The offices can also assist you in just finding the right lender who also participates with our guaranteed loan program. Okay. Questions, or I know that's a lot of information to cover all at one time, but I'd be glad to answer any questions, general questions that you might have.
Thanks, Kim. That was great. I don't see any questions in the chat. If you all have the capability to raise your hand or unmute yourselves, you're welcome to do so as well. Okay. I'm not seeing or hearing. Application. Do you mean through email, Tammy? And then another question, if you fall into a BFR and SDA, which one would you do?
So you can actually do both of them. So as you are providing your information on the application, that's something that we will make sure that you can get, that you're eligible for both of those, because they do have several pools of money. So just mark everything as it applies to you, and we'll do that on our part.
Perfect. And then I can also put it in the chat here for you as well, for that loan tool. Let's see here. And she said, thank you for the clarification. I'm not seeing any more questions. As they pop up, Kim is going to stay on until we are finished, I believe. So for the last couple items for our webinar, we just have a couple upcoming program deadlines and important dates for all of the agencies. For the Farm Service Agency, our main ones are March 29th. Our General Conservation Reserve Program deadline is coming up. April 29th, our Dairy Margin Coverage Program, or DMC, deadline is also coming up. And then for July 15th, it's our spring crop reporting deadline. We did talk about CRP and spring crop reporting in our first webinar series. If anyone has questions, feel free to go to our website and look at our fact sheets, if those might be programs you might want to participate in. NRCS didn't have any pressing deadlines, and neither did RMA. But RD has a couple. They have March 31st. They have the Rural Energy America Program grant deadline. That also has some more deadlines within June 30th and September 30th. And then they have an April 16th deadline of the value added producer grant applications. There is a question in the chat on if we have any information about energy programs. They're interested mainly in solar. Amy, are you still on to talk about any solar programs you might have?
I am, and that actually falls under our Rural Energy for America program. Those are the grants. Those are for farmers and ranchers as well. So who has it? Let me look at the chat. Who has that? Tammy, I'm going to put my information in the chat. And then if you want to talk offline about the program, I can make sure that we get you to the right person, because we have several deadlines coming up. Does that work? Oh, perfect.
Of course, Lauren, thanks for joining. For the rest of you that are still with us, we have some future upcoming webinars. Please note that you do have to register for each webinar individually. They are different topics and they are different links. Those will be on our Colorado FSA website as they become available. Our next topic will be how to get started with FSA and why it's important. We'll do a little bit of general farm program overviews like we did in the first meeting, but then we'll really dive into what you need to get started with FSA, how to contact your local offices, what you should bring, all of that fun jazz. And then our future ones are also listed here. And then these are the contacts from all of the people from this last meeting. I will pause in case you want to take down any of the information. Amy did put her email in the chat as well. Perfect. And then any other questions for those that are still with us? If not, thank you so much for joining us for our Farm Loans Month 2. Hopefully we will see you next month for how to get started with FSA. And as always, if you have any questions or concerns, reach out to us. Thanks, everyone.